Okay, so good afternoon, and I am Professor Anuradha Jain. In this session, we will be discussing about monetary policy, types of monetary policy, how effective the monetary policy is, and how important it is. So, monetary policy is the policy of the Reserve Bank of India to control the supply of money in the economy. It's a very, very important policy, and it plays a very prominent role in the development of any country. It's a kind of double-edged sword. If money is not available in the market as the requirement of the economy, the investors will suffer because investment will decline in the economy. And on the other hand, if money is supplied more than its requirement, then the poor section of the country will suffer because the prices of essential commodities will start rising. So therefore, the balance between the supply of money and the demand for money has to be created in the economy. And through various instruments of monetary policy like qualitative methods, quantitative methods, like changes in the bank rate, changes in the interest rate, changes in the reserve ratios like CRR, SLR, RBI try to control and manage the money supply in the economy. So in this session, after discussing what monetary policy is all about in the previous session, we will be now discussing about what are the types of monetary policy. So monetary policy changes as per the goals set by emerging economic situations. So these policies are characterized as, so there are different types of monetary policies depending upon the economic situation of the country. There are 5 types like expansionary monetary policy, contractionary monetary policy, counter-cycled policy, rule-based policy, or discretionary monetary policy. Now, if we talk about expansionary monetary policy, then expansionary monetary policy is when central bank uses its tools to stimulate the economy. That increases the money supply, lowers rate of interest, and increases demand. So that means expansionary monetary policy means in this they increases the money supply in the economy, and money supply can be increased only by decreasing the rate of interest, because if rate of interest decreases, the investment increases and demand increases, or by decreasing the reserve ratios like SLR, CRR, because in that case also the supply of money in the economy increases. So by doing so, it boosts economic growth, it lowers the value of currency, thereby decreasing the exchange rate. So it is the opposite of contractionary monetary policy. Expansionary monetary policy, deters the contractionary phase of the business cycle, but it is difficult for policy makers to catch this in time. So as a result, typically see expansionary policy used after a recession has started. Because when there is recession in the economy, then the objective is to achieve the economic growth target or to bring the economy, in the recovery phase or in the boom phase. And for that, they need to have the expansionary monetary policy because they need investment to be increased, they need demand to be increased. So therefore, expansionary policy is helpful when there is recession in the economy. An expansionary monetary policy is focused on, expanding the money supply in the economy. Now, if a country is facing high unemployment rate, suppose, especially during a crisis period such as slowdown or recession, the monetary authority of the country, which is usually the central bank of the country, can opt for an expansionary policy that is aimed at increasing economic growth and expanding economic activity. And this is also known as easy monetary policy, because expansionary policy, because easy monetary policy means money is easily available in the economy, money supply is more in the economy. An expansionary monetary policy is implemented by lowering key rate of interest, thus increasing market liquidity. High market liquidity usually encourages more economic activities, because if there is money in the pockets of the people and if purchasing power is high, then they can expect to spend more money. Like suppose if you go to the market and if you don't have money in your pocket, then how will you demand the products? Okay, or Even if you wish to buy, you will not be able to buy because you don't have money for it. So if money supply increases, purchasing power increases, then obviously the economic activity will increase, demand of the commodities, demand for the services will increase. Now when RBI adopts expansionary monetary policy, then they decreases the policy rates, okay, like interest rates, like repo rate, reverse repo rate, MSF, bank rate, etc. They decreases the reserve ratio, okay, like cash reserve ratio, statutory liquidity ratio. They buy government securities from the people, from the market, as a part of open market operation, providing liquidity in the market, because you know that when they buy government securities, it means that they are giving money back to the banks or to the public, those who have purchased these government securities. So if buying means giving money and increasing money supply in the economy. So therefore expansionary monetary policy is used usually, you know, when there is recession in the economy. Now for example, if you see that expansionary monetary policy used by Federal Bank of US during 2008. Now in 2008, you know that there was a great recession, and the Fed used innovative expansionary monetary policy tools to combat the financial crisis. They were all new ways to pump more credit into the financial system. So that means they wanted to increase money supply, and they wanted to give more loans, and they want to pump in money in the economy. The term auction facility allowed banks to sell their subprime mortgage backed securities to the Fed. The Fed established asset backed commercial paper money market mutual fund liquidity facility, and this program loaned around $122.8 billion to banks to lend to money market funds. Now in this case, Fed also created more powerful form of open market operation known as quantitative easing. Now with this quantitative easing, the Fed added mortgage backed securities to its purchases. So therefore you can say that in 2008, after the great recession in the US, the Fed adopted expansionary monetary policy there. Now second type is contractionary monetary policy. Now contractionary monetary policy is when a central bank uses its monetary policy tools to fight inflation. Now it is called a restrictive monetary policy because it restricts liquidity. Because if there is inflation, they have to restrict the liquidity, they have to reduce the purchasing power, and they have to reduce the money supply in the economy. The bank will raise rate of interest to make lending more expensive, and that reduces the amount of money and credit that banks can lend. So it lowers the money supply by making less loans, credit cards or mortgages more expensive in the market. And contractionary monetary policy is focused on contracting or decreasing the money supply in an economy. Contractionary monetary policy is when a central bank uses the tools of monetary policy in order to fight inflation. So since inflation is a sign of an overheated economy, the bank must slow economic growth in order to control the situation of the inflation. So the contractionary monetary policy may result in slowing down economic growth and an increase in unemployment, but is often required to control inflation. Because as we said that there is always side effects of any policy measures taken. So if there is inflation in the economy, and to control inflation, if RBI is using contractionary monetary policy, they are trying to reduce money supply from the economy. So it means that when they reduce it to control inflation, then obviously it will have side effect that the growth rate may go down, and which may also lead to increase in the unemployment in the economy. Why? Because if investments are less, if prices they are controlling, it means that unemployment tendency is that it will increase in the economy, and that Phillips have explained this through the Phillips curve. That means the interrelationship between the inflation and unemployment in the economy. So, contractionary monetary policy sometimes may lead to increase in the unemployment in the economy. But to deal with this problem, which is a side effect of contractionary monetary policy, there are other policy measures that can be adopted, okay, or fiscal policy. They can have different other instruments they can use to control unemployment. So, this contractionary monetary policy is also known as tight monetary policy, because they make the situation tight in terms of the supply of money. A contractionary monetary policy is implemented by increasing, key interest rate and reducing the liquidity in the market, or low market liquidity usually negatively affect production and consumption, and they may also have a negative effect on the economic growth. Now, when RBI adopts a contractionary monetary policy, okay, then what do they do? As we have discussed, that they increases the policy rates, interest rates like repo rate, reverse repo rate, MSF, bank rate, etc. They increases the reserve ratios like cash reserve ratio, statutory liquidity ratio, that is SLR. Now, RBI will sell government securities from the market as part of open market operation and taking out liquidity from the market. Now, on the basis of an assessment of the current and evolving macroeconomic situation, the Monetary Policy Committee, MPC, at its meeting on 8th June decided to increase the policy repo rate under the liquidity assessment LAF by 50 basis point to 4.90% with immediate effect, and consequently the standing deposit facility rate, that is SDF, adjusted to 4.65%, and the margin standing facility, that is MSF rate, and the bank rate to 5.15%. Now, MPC during this time also decided to remain focused on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. Okay, so these decisions are in consonance with the objective of achieving the medium term target for consumer price index inflation of 4% within a band of plus minus 2% while supporting the growth. Okay, so this is the example of our RBI's Monetary Policy Committee, like how they take decision, how they adopted contractionary monetary policy, because we were facing problem of inflation here. Now, if we take the example of Federal Bank of US during 1970s, now from 1972 to 1973, inflation jumped from 3.4% to 8.7%. And there were many reasons for this drastic, dramatic price rise, such as wage control and, untying the dollar from the gold standard. Now, to combat this situation, the Federal Reserve increased the Fed funds rate from 6% in January to 11% in August. So, that means you see from January to August, the funds rate were increased by 5% from 6 to 11%, and this reduced inflation to around 5.7%. See, they were facing the inflation rate of 8.7%, and by adopting the contractionary monetary policy, they could reduce it to 5.7%. Okay, so this was the example like how contractionary monetary policy helps in controlling the situation of inflation in the economy. Now, another type of monetary policy is counter-cyclical policy. Now, counter-cyclical policy refers to the steps taken by the government that go against the direction of the economic or business cycle. Now, therefore, in a recession or slowdown, the government increases expenditure and reduces taxes to create a demand that can drive an economic boom. Now, on the other hand, during a boom in the economy, counter-cyclical fiscal policy aims at raising, taxes and cutting public expenditure to control inflation and debt in the economy. Now, another type of monetary policy is rule-based monetary policy. Under rule-based policy, money supply and related variables are controlled by predetermined rules, norms and standards. Now, the central bank authorities cannot use their discretion to change the values of these variables. So, that means in the rule-based monetary policy, everything is controlled by predetermined rules. So, therefore, whatever be the situation, they may not be able to change the rates as per the requirement of the economy, but they have to go by the rules that are determined by the government. Another is discretionary monetary policy. Now, it allows the central bank greater autonomy in the conduct of monetary policy. Now, under such policy, rather than getting constrained by the preset rule, the central bank, after assessing the emerging economic scenario and using its own judgment, can change the values of money supply and related variables in the economy. So, this discretionary monetary policy, you can see, is just the opposite of rule based policy, because in rule based they cannot change, they have to go by the rule whatever be the situation in the economy. But under discretionary monetary policy, central bank is having greater autonomy. They are free to change the rates as and when required, depending upon the monetary policy in the economy. Now, another very important topic related to this monetary policy is monetary transmission mechanism. Now, what is monetary transmission mechanism? It's the process through which monetary policy decisions affect economic growth, prices and other aspects of the economy. So, it's the transmission mechanism, like how the process takes place, how the change will come in the economy, or how the step taken by monetary policy will affect the economic growth or will affect employment or investment in the economy. So, in simple terms, you can say that transmission can be summarized in two stages. Like, first is changes to monetary policy affect interest rate in the economy, and then changes to interest rate affect economic activity and inflation. So monetary transmission mechanism, like in short term, if you see, then changes in the four channels affect the demand for goods and services. Then there will be change in the market rates, impact the cost of borrowing, which affects the demand for credit and related consumption. And for example, a decline in the interest rate may make consumer credit more affordable, because see, as I gave you example earlier also, like if there is change in the interest rate, then that may lead to increase in the demand for the products in the economy, or demand for money in the economy, that will change, and because of that demand for the products and services will also increase. As I gave you example, like nowadays consumer durables are in demand, their demands have increased. Like suppose if you take the example of COVID also, during COVID people were in need of more gadgets, electronic gadgets for suppose attending classes and all. So they were in demand for smartphones or laptops or desktops, etc. And people could buy because easy loans were available at a very, very lower rate of interest. So decline in the rate of interest may make consumers to afford to buy more goods in the economy. So that is monetary transmission mechanism, like how the change in the rate of interest has affected the demand, final demand in the economy. And not only that stops here, but increase in the demand will also lead to further more investment of these products in the economy, and more investments means more employment, then income increases, then again demand increases. So this is the process, like how change in one factor will lead to changes in the other factors in the economy. Now, changes in the asset prices affects people's consumption through the wealth effect also. A person who sees his or her portfolio of assets increase in value may feel richer and be, more willing to spend money. Because if they have assets, and suppose if there is a change in the, assets of the people or fixed assets that people possesses, then wealth effect. How wealth effect? Because we feel that yes, we have this much of assets with us, and we can feel safe that yes, we are safe for future. Okay, so don't have to save more for future. For precautionary measures, you don't want to save more here in this case. So you are willing to spend more money in the present situation, and you don't want to save more because you feel safe because of the wealth that you have, because of the value of the property that you have. Okay, so that also affects the demand for the products in the market. So changes in the asset prices also play a very, very important role in the monetary mechanism, transmission mechanism. Then changes in the confidence and expectations can affect demand as well. Like for example, expectations of economic growth may make people less cautious and more willing to spend on goods and services. Okay, because you get confidence that yes, your income will be there, okay, because economy will grow, your job is safe and your income is safe. So in that case, you can demand more goods today. Then changes in the exchange rate can affect your imports and exports. A decline in the value of domestic currency can result in a positive impact on exports, while an increase in the value can benefit imports. Okay, so what is your exchange rate of the economy? If there is a change in the exchange rate because of the changes in the monetary policy, that will affect your exports and imports. Okay, so that will again affect your reserves, your foreign reserves of the economy, and overall demand of the economy will be affected because of this. So borrowers fail, to fully benefit from RBI's repo rate cut due to the following reasons. Like banks are not affected by RBI cuts as the central bank is not their primary, monetary supplier, and deposits already made are fixed at the rates when taken and cannot be reduced. So the rate cuts will only reflect in the new deposits rates. Now PPF or post office accounts and other small savings instruments are available at high administered interest rate, and in case of reduction of bank deposits rates, customers have the choice to move to those funds. So banks do not prefer to lower rates as high lending rates keep their profit margins up. Now India does not have a well developed corporate bond market, therefore corporate customers have little choice but to reach out to banks for borrowings. Now what are the steps to improve monetary transmission? Now both the government and RBI has taken and plans to take some steps in order to accelerate the transmission of monetary policy. Government intends to bring down the interest rate on small saving accounts. If the small saving rates are linked to the bank rate, this could serve as a permanent solution for this. And in order to improve monetary transmission, RBI wants banks to change the calculation methodology of the base rate of margin cost of funds from average cost of funds. Then despite banks raising the lending rates immediately after RBI's cut rates, the central bank is unable to control inflation due to many reasons like financial deficit in the higher government, okay, then issues at the supply side such as crude oil prices, issues in agricultural marketing, etc. Lack of financial inclusion as borrowers still depend on money lenders who are not under RBI control. Non-monetized economy in certain rural areas. Now changes in the interest rate can affect demand via several channels. So therefore the idea here is that monetary policy is very, very important for any economy, but there are lags in the monetary policy, and these lags are like recognition lags, administrative lags, operation lags, and to have monetary policy to be effective, we have to reduce this lags or this time period in between the effectiveness of monetary policy, and that will only lead to effectiveness or effectiveness of the monetary policy in the economy. So monetary policy is a policy which is very, very important for any government for to have economic growth. But since one policy cannot be sufficient to achieve economic growth, so government has to go with the policy mix like monetary policy and fiscal policy both together. So thank you so much for allowing me to take this session, and we will meet again with other topics of macroeconomics. Thank you.